Joining me is Charlie Bobrinskoy, Vice Chair, Head of Investment Group at Ariel Investments. Great to see you, Charlie. Welcome.
Hey, Kelly. Nice to see you.
I figured let's just pick up the thread that Paul McCulley was just laying out there. You sound like you're in a very similar camp, but you have some tactical ideas as well for what investors should do.
Yeah, so I agree with a lot of what just got said, that there's now a chance that we're not going to have a recession. There was always a chance. We never know for sure, but I would now put the odds of a recession at less than 50-50. And the great news is that the market is still penalizing those cyclical names. That's what's cheap right now. Are housing-related names like Mohawk Carpets and Surfaces, Borg Warner, the automotive supplier, Goldman Sachs trading at about book value. All of those names will do very well if we don't have a recession, and yet the market is still looking for those defensive stocks, the tech stocks, the names that are not cyclical. So I think there's a real opportunity here with the inflation number that we got today and the fact that I think we're going to continue to have good inflation numbers because the Fed is overstating shelter costs. Rents are dropping, and that is not in the Fed data right now. We're going to have that data in the future months, so we're going to get good news on inflation. I think we are done raising rates, and that could mean we don't have a recession, and that's a very good setup for some very cheap value stocks.
Well, you also got to be smiling. Am I wrong, or are you an Oracle guy? I mean, what a story that stock is.
That's very nice of you to mention that. It was really the cheap tech name. It was a contrarian name that was trading 13, 14 times earnings, and yet has a much better position in the cloud than it's ever been given credit for. And that's starting to flow through in the earnings. It's actually was my biggest position, and it's having a great, great year. It's getting close to not being a value stock anymore,
right,
but still very reasonably priced at about 20 times earnings.
For the sake of those watching who maybe weren't in it and are wondering, are you going to sell or trim here? What's your sort of philosophy?
Yeah, so it's gone from fat pitch, leader in the industry, great growth prospects trading at 14, 15 times, to being attractive but not dirt cheap anymore. So it probably shouldn't be my largest position anymore as it was. But still a great name with very good growth prospect, now trading at let's call it a fair valuation.
So you mentioned some housing plays, obviously the home builders, we've got some all-time highs today. There's some hope now maybe that'll spill over to the Home Depot and some of these other parts that you mentioned. I'm just going to ask the obvious question. What if we do go into recession, and however long that may take, do you throw out those names from the playbook and get a different playbook or not?
I think the good news is that they're still being priced like we're going to go into a recession and a housing recession, and that is still possible. I don't want to say that can't happen. The Fed has disappointed me with their actions up until now, and they could do something stupid like raise rates tomorrow, and that would be very disappointing, and it would not be good for housing stocks. But the market is already pricing a lot of that probability in, so I think even a downturn in the economy wouldn't be devastating for a stock trading at 9 times earnings.
Yeah, so in other words, you don't suddenly exit those positions. You just kind of have to wait a little longer maybe for them to bear fruit. I'm sure that would apply to a Goldman as well. So, in this kind of situation then, if someone says, all right, well, then what's the next Oracle? What's the next stock? And maybe it's one of the ones you already mentioned. Are there kind of under the radar areas where you think the valuations is incredibly compelling? Because a lot of the rest of the market is starting to look pretty, full by that metric.
Yeah, I do want to call out, it's been a very tough year for commodities. But if we have a decent economy, then demand for commodities is going to be solid. And so I do happen to believe that some of the oil names, Apache's, when I talk about trading at 5 times earnings,
wow,
and then Mosaic, of course, is trading at less than 10 times earnings. There's going to be demand for agricultural fertilizer. Those stocks are cheap because people are worried about a recession as well. And if there's a recession, there'll be a downturn in demand for oil and gas. But if there isn't, those are very attractive names that could perform very well.
Quick last question, Charlie. Some like Tony Sacconaghi yesterday have kind of tallied this up and say it's the most lopsided market ever. Just those 10 stocks contributing to gains. Just because you've seen plenty of these cycles, does the trading action you've seen year to date concern you? I mean, does it itself tell you that this is an imbalanced market that's going to be prone to toppling over, or no?
It concerns me for the S&P 500. Absolutely. This is one of those markets like 1999, and where you have a certain group of stocks that are trading at very high prices, and then a whole lot of stocks that are trading cheap. And people are seeing the S&P 500 be up so much and thinking, oh my gosh, the stock market is overpriced, where it really is just 8, 9, 10 names. So I am nervous for the general investor who's thought you could just index and put your money in the S&P 500 and you'd be okay. I think the S&P could really underperform here if the scenario that I'm calling for turns out to be true.